We are diving straight into the action. Wall Street is watching NVIDIA Corporation with a market cap crossing nearly $5.5 trillion. But the real story isn't the valuation. We break down why Jensen Huang is fundamentally changing the math, arguing that the computer of the future is manufacturing equipment, not just a tool, and how this framework dictates the path for NVIDIA through 2030. Target to $320, showing the sheer uncertainty surrounding AI spending. We dissect what these differing targets mean for the upcoming earnings report and what signals management needs to give on Blackwell timelines. Finally, we track the smart money. We investigate the extraordinary performance of Prime Capital Management, run by Liu Yijun, and their concentrated bets on NVIDIA, Micron Technology, and TSMC, asking which hedge funds got the timing right in this explosive semiconductor trade. Don't miss this analysis, and make sure you subscribe now for all the insights you need to navigate the market. NVIDIA Corporation, currently the world's most valuable company with a market capitalization nearing $5.5 trillion, is facing a significant divergence between its valuation and analyst price targets. While the average analyst price target remains around $273, the underlying business narrative suggests substantially higher potential. The core of this argument centers on shifting the fundamental way NVIDIA should be valued, moving beyond its perception as merely a chip company to that of a manufacturer of essential AI computing equipment. CEO Jensen Huang has argued that future computers are evolving into manufacturing equipment, comparable to ASML's machinery, which produces a tangible product. This reframes the valuation equation, suggesting the focus should shift from what a server costs to what it produces: tokens, code, and decisions generated by AI models. The key efficiency metric in this new framework is tokens per second per watt, highlighting the superior performance of the next-generation Blackwell and Vera Rubin architectures. This technological advantage translates into significant financial benefits. The Vera Rubin chip is projected to deliver substantially higher performance per watt than the current Hopper generation, driving customers to favor newer systems that offer lower cost per token. This dynamic has maintained high gross margins, reaching 71.1% as the company scales its annual revenue to $215.9 billion. Management has provided robust forward guidance, with projections indicating over $1 trillion in demand for Blackwell and Rubin chips through 2027, with an estimated $1 trillion demand through 2027 based on updated figures. Furthermore, the integration of the low-latency Grok chip is expected to boost factory compute spending by an additional 25% for workloads requiring fast, deterministic output, a demand segment not fully reflected in current street models. Despite these strong fundamentals, market concerns persist, primarily revolving around China revenue volatility and the potential slowdown in hyperscaler capital expenditure. However, bulls counter these concerns with the massive order book and the structural demand for AI infrastructure. Analyst sentiment has recently shifted, with several firms upgrading price targets, moving them toward the $320 to $350 range. The TIKR model suggests a potential valuation of around $587 by January 2031, contrasting sharply with the street's $273 target. The primary risk remains valuation multiple compression if hyperscaler capex disappoints, or if in-house custom chips from major tech firms significantly erode GPU workload share. The immediate future hinges on upcoming guidance. The critical indicators are the second quarter revenue guidance and any clarity from leadership regarding the Chinese market, which Huang has estimated at approximately $50 billion in annual revenue, a figure currently absent from most street models. If Q2 guidance meets or exceeds consensus and the Grok shipment schedule is confirmed, the tokenomics argument is expected to transition into tangible revenue reality. Conversely, softness in guidance coupled with lack of progress in China will test the credibility of the massive demand projections. Zacks Value Trader report highlights key technology stocks: NVIDIA, Micron Technology, and SanDisk. Published on May 18, 2026, this research from Zacks Investment Research signals a focus on significant movements within the semiconductor and storage sectors. The report specifically calls out NVIDIA, Micron Technology, and SanDisk as key areas of interest for value traders. While the provided snippet is brief, it underscores a current market focus on these three entities, suggesting potential opportunities or significant shifts in their respective market positions. Investors tracking Zacks equity research are advised to monitor subsequent updates for detailed analysis on the drivers behind these highlighted stocks. Alethea Capital has significantly increased its price target for NVIDIA ahead of the upcoming earnings report, setting it at $270, up from the previous $250. The firm's bullish stance is grounded in the expectation that the overwhelming demand for AI chips will allow NVIDIA to surpass Wall Street's revenue estimates by an additional $2 billion to $3 billion. This move joins a growing consensus of optimistic analyst calls surrounding the chipmaker. The rationale centers on the belief that the market is currently underestimating the massive capital investment flowing into AI infrastructure. Analyst Stephen Chang supports this view, predicting a substantial revenue beat based on the intense demand for AI hardware. This sentiment is echoed by other major financial institutions. TD Cowen recently raised its target to $275, citing order pipelines that the firm assesses exceed $1 trillion. Even more aggressively, Bank of America has set its target at $320, basing its projection on an analysis of AI data center demand. NVIDIA's stock has experienced a dramatic surge, gaining 36.41% since March 30th, a performance largely driven by announcements of AI-related capital expenditure from major cloud providers, enterprise customers, and even sovereign wealth funds. Competition for GPU allocation is fierce, with giants like Microsoft, Google, Amazon, and Meta vying for access. The differing analyst targets, ranging from Alethea's $270 to Bank of America's $320, highlight the genuine uncertainty surrounding the ultimate trajectory of AI spending. Investors should view the upcoming earnings report less as a reflection of past revenue and more as a crucial indicator of forward guidance. Key factors for the stock's future valuation will be NVIDIA's commentary on the Blackwell chip ramp timelines, projected gross margin improvements, and customer ordering patterns for the latter half of the year. These forward-looking statements will ultimately determine whether the stock reaches the $270, $320, or a lower valuation. A Hong Kong-based investment fund, Prime Capital Management, led by Liu Yijun, has been generating exceptional returns over the past year through concentrated investments in key market performers. Analysts are tracking this fund as a case study in strategic timing within the recent semiconductor and artificial intelligence surge. The fund's success stems from a deliberate strategy of concentrating capital into a small number of high-conviction stocks, rather than broad diversification. This approach has allowed the fund to capitalize significantly on major market rallies. The core of Prime Capital Management's portfolio is heavily weighted toward four major names: NVIDIA, Taiwan Semiconductor, TSMC, Micron Technology, and Tesla. These holdings have been primary drivers of the fund's performance. Micron Technology stands out particularly, having seen an impressive 82% gain in just the last 3 months, which highlights the timing advantage the fund secured, despite the stock appearing expensive earlier in the year when the semiconductor trade was less intense. The analysis suggests that while replicating past moves is difficult, tracking the actions of sharp, well-timed funds remains valuable. The author recommends monitoring upcoming 13F filings from major investment funds to identify successful long-term positioning. Furthermore, Tesla is highlighted as a potential standout conviction holding. With a significant weighting, the stock's potential for explosive growth, driven by future initiatives such as robotics, full self-driving technology, and advanced manufacturing capabilities, is seen as an area where the market may be underestimating its true potential, especially given its more modest gain over the past year.